So hiking its dividend by 10%, joining us now here on set, Broughton Capital principal and managing partner, Donald Broughton. Donald, thanks for being here. You were at the meeting today.
I was.
Were you surprised to hear that they're doing this broad restructuring and bringing Express and Ground together?
I was surprised at how dramatic the move was and how quickly they've made it. Fred Smith, the founder, retired. And the meeting in June in Memphis, Raj, the new CEO, talked about what he was going to do next and the cost controls and what they were going to do. And might I add, the cost controls were clearly in place this morning. I remember back 20 years ago at the 2003 analyst meeting, they gave us all iPod minis. And I went to compliance and said, can I take this? I didn't even get a pin this morning, not even a pin. So obviously the cost control is firmly in place. But they talked about how the company is changing culturally. If I look at the last 25 years since UPS came public, basically UPS, to their credit, has tripled revenue in that time frame. But FedEx has almost six-folded revenue. But they've aggressively spent on CapEx to do so. They've spent 5.5% to 10.5% of revenue as CapEx, and UPS has spent 3 to 6%. And what FedEx is basically saying is, look, we've caught them in revenue. We've built a dominant global transportation platform network, and now we're going to start harvesting things a bit. That was one of the messages. And the other message is that, look, here's our next agendas on costs and what we're going to do with capital. So you can almost assume that what we announced in June is already done or put in motion to have happen.
Do you think we would be seeing these types of changes now if it wasn't for the pandemic and supply chain issues and the fact that FedEx, in many instances, was caught flat-footed, or at least appeared to be caught flat-footed with its operating structure as it has existed up until today, and what that meant in terms of higher costs, potentially lost business, and the fact that UPS thus, or at least the stock, was able to outperform?
No, I don't think that's as much as it. Well, caught flat-footed. Nobody expected the pandemic.
Yeah.
So we were all caught flat-footed. That said, I think what has happened is there's a combination of things. One is that Fred Smith, to his credit, built this company over the last 50 years. But people used to talk about when are we going to see more free cash flow, and I'm like, you're never going to see free cash flow. Jack Welch may have popularized the notion of being number one in everything you compete in, or number two on your way to becoming number one. But Fred Smith actually lived it, actually made it happen in the marketplace. He would go find every little nickel and dime that was under the couch cushions of free cash and deploy it in building or buying additional businesses for his franchise that he was building. But this is a new generation. This is a new management team, and they're clearly saying, hey, we've already built the biggest, baddest, so now why don't we harvest what we've built?
So what's your take on the stock? You're bullish.
I am, and here's why I'm bullish. If I look at what they were saying and what they've done, and I see that reduction in costs, I see that reduction in CapEx, and I look at I see a very clear path to more than $30 a share in earnings and a dramatically higher return on invested capital, which ought to drive valuations. And if I look at the valuation disparity between the two companies, I say, well, UPS is basically trading for what? The market cap is basically relatively similar revenues, trading for 2.9 times the market cap, almost 3 times the market cap. So if FedEx can do what they're saying they're going to do from a margin and a return on invested capital perspective, then arguably the company ought to trade for 3 times the market cap. And, usually a 3x, even if it takes you 3-5 years to do, that's a decent return in any market.